By June 22, 2026, the AI memory supercycle had done the unthinkable. Micron, a company once valued as a volatile commodity play, pushed past a $1.2 trillion market cap as it hit an all-time high of $1,211. But within 24 hours, that record shattered. A sudden liquidation in South Korea's Kospi index triggered a global exit. Tech heavyweights Samsung and SK Hynix saw double-digit drops, dragging Micron down with them. This wasn't a failure of AI demand, it was a technical unwind, a collision of localized retail leverage and a massive rotation of foreign capital out of the region. Despite the dip, the immediate hurdle for investors is a fiscal third-quarter print that demands absolute perfection. Wall Street expects $34.5 billion in revenue, roughly 4 times what the company generated just 2 years prior, with record gross margins of 81%. With options pricing in a 14% swing, we're at a crossroads. You have to decide if this 12% flash crash is a rare buying opportunity or the first crack in a massive valuation bubble. To navigate this, we have to look past the ticker. We need to determine if Micron has actually replaced its old commodity-driven business model with a permanent role in the AI infrastructure stack. In the old memory market, supply was easy to scale, which led to frequent overproduction and price collapses. High bandwidth memory, or HBM, changes the industry because it is physically difficult to manufacture. Unlike standard chips, HBM uses vertical stacking. Manufacturers align and bond multiple silicon layers with microscopic precision to reach speeds required by AI accelerators. This complexity introduces a massive manufacturing tax, the 3-to-1 wafer penalty. Producing 1 unit of AI memory consumes the raw silicon capacity of 3 standard wafers. Between complex wiring and high rejection rates, factory efficiency takes a massive hit. Leading AI hardware designers have qualified this memory for their next-generation accelerators. They have no choice but to pay for it. Without these stacks, their graphics processors can't access data fast enough to function. This creates a cannibalization effect across the globe. For every wafer Micron dedicates to HBM, 3 wafers worth of supply are removed from the markets for PCs, phones, and traditional servers. By diverting capacity to meet AI demand, Micron has created a structural shortage in the rest of the market. This explains why prices for basic memory are surging alongside AI components. This physical squeeze is what allows Micron to project 81% gross margins. They aren't just raising prices, they are operating in an environment where global supply is physically capped. The HBM penalty acts as a natural moat. It prevents the rapid capacity expansion that used to flood the market, effectively ending the era of predictable memory crashes. Beyond physical constraints, Micron is changing how it sells. They are transitioning from being a generic vendor to a specialized co-design partner. Look at the June 22nd deal with Anthropic. This isn't a simple sales order. It's a strategic agreement to build memory and storage architectures specifically for future Claude models. This matrix shows the business model shift. The traditional commodity route leaves revenue at the mercy of spot pricing. On the right, co-design leads to multi-year contracts. By signing these, Micron secures workload-specific allocation, removing valuable supply from the open market and locking in revenue. Management is aggressively pursuing these commitments to prove that their future earnings aren't just a temporary result of the current boom. However, as an investor, you have to acknowledge the missing data. The exact dollar amounts and volume guarantees of the Anthropic deal are still hidden in confidential filings. Because we can't see the specific contract details, we are essentially forced to trust that these partnerships are as durable as management claims. If these long-term agreements are as solid as they look, Micron's revenue stream begins to resemble a predictable infrastructure utility for the AI industry. While the 2026 supercycle story is strong, you have to face the immediate risks of the earnings print tomorrow. The short-term market is currently priced for an absolute miracle. Implied volatility for this week is over 150. If you believe that earnings projection is achievable, the stock is fundamentally cheap at today's price. But playing the options market here is a high-stakes gamble that requires management to be absolutely perfect right now. So how do you handle a stock that just fell 12%, but is still trading at record-breaking revenue multiples? For the short-term trader, the path is clear. Buying naked calls into this print is a bet with a negative edge. The risk of IV crush is too high. Micron frequently sells off after its report, regardless of estimates. For the long-term believer, the strategy changes. You're looking past the earnings noise toward that 2028 valuation. Wait for the post-earnings dust to settle and scale in if the stock tests support in the $800 to $900 range. You're playing for the eventual re-rating to that $1,500 target. But watch for the red flags. If big tech companies start cutting their AI capital expenditures, the demand pillar breaks. Without those massive budget guides, the HBM penalty stops being a moat and becomes a liability. The stock would revert to being a cyclical commodity, and the 2026 supercycle would likely come to a violent end. Keep an eye on one specific metric tomorrow: the pricing on 2027 HBM contracts. If those are locked in and resetting higher, the structural moat is real, and the dip is a generational opportunity.